Welcome all to the Market Pulse podcast. I'm your host, Jesse Harden, a member of the Equifax advisory team. So as a group, we identify economic considerations and we leverage data and analytics to translate into industry insights. This helps us make recommendations to support our clients during economic uncertainty, and we help uncover growth opportunities in the consumer credit risk space. I'm pleased to welcome our usual cast of characters masquerading as our panel of experts, Aliff, Tom O'Neill, Dave Sojka, and Maria Urtubey. Welcome all.
Hey there, Jesse.
Hey,
Hey guys.
Hey.
Nice to see everybody.
Yeah, so this December podcast, it's always a fun one for me. This episode, we always want to look back on what's transpired in the prior year. So in this case, look back at 2024. So we're going to look at some of the key aspects of the economy, what improved and what didn't, and we'll look at the impact to the Americans in their everyday lives. I like this podcast really because I think it's easier to look back in retrospect than to make predictions moving forward. Were we right? Were we wrong? Or both? So stay tuned to find out. But before we get started, I've got an important question to ask everyone. Since this episode was recorded after Thanksgiving, did anybody watch a favorite Christmas movie?
So Yippee-ki-yay was my first Christmas movie. And to all you doubters out there, love conquers all in the end. So yes, it's the magic of the holidays. And then for my second movie, we have a little prop comic here. I love syrup on spaghetti. We watched Elf.
I'm going to guess that it was the likeness to Bruce Willis. Is that the the reference?
All
right. Em, how about you?
I've always enjoyed the movie It's a Wonderful Life. I haven't watched it yet this year, but I will. I really quite find it really interesting how the main character George jumps off the bridge to save his guardian angel, and then they do the flashback of his life of what things were like with and without him around, and to see like what are all the things that he did, and everyone kind of pulled through for him when he needed it most.
Yeah, it's a good story. How about you, Tom?
So for me, the tradition is A Christmas Carol, but not just any Christmas Carol. There's like a dozen, well, probably way more than a dozen versions, but specifically A Christmas Carol with George C. Scott. So that's the one that I force the my wife and kids to sit down with me and watch, and they always complain. But at the end when Scrooge discovers the meaning of Christmas, everyone's giggling. Well, maybe it's just me giggling, but it sounds like it's everyone giggling. So
yeah,
so it's definitely a family tradition to watch that. We haven't seen it yet. We usually see it like a day or two before Christmas Eve.
I get forced to watch White Christmas like that. Maria, how about you?
Haven't rewatched it, but my favorite is Home Alone. I have to say,
classic,
hands down.
Yeah. And I'm going to go with another classic. I'm going to go with Christmas Vacation. I can't. I've got to pick a Chevy Chase movie. He's one of my heroes. Pretty funny one. Even though it sounds like you don't like it.
How sad is it that I've only watched I haven't watched any of the ones that you guys mentioned. I have to get on the ball.
Sounds to me like you got some homework to do.
I do. This is going to be a busy holiday season. A lot of screen time.
No work being done.
Yeah.
Well, I'll tell you what, then, before we dive into the 2024 retrospective, let's get a quick macroeconomic overview from our friends at Moody's Analytics.
The U.S. economy continues to show remarkable resilience, but it isn't all sunshine and rainbows. In November, the economy added 227,000 jobs, a significant rebound from October's upwardly revised 36,000 gain, which was weighed down by labor strikes and hurricanes in the Southeast. November's jobs report lifted the three-month moving average in payroll growth from 123,000 to 173,000. The healthcare and leisure hospitality industries continue to account for a disproportionate share of payroll growth, and did so even more than usual in November. Nonetheless, the breadth of job creation has widened in recent months, as the Bureau of Labor Statistics Diffusion Index, which measures the percentage of industries adding to payrolls, has steadily increased above the 50-point threshold, showing that a majority of industries are hiring, at least somewhat. The household survey was less cheerful. The unemployment rate ticked up from 4.1% to 4.2%. Unlike previous monthly increases in the jobless rate, November's uptick was owed not to a fast expanding labor force, but rather a decline in jobs. Even so, the share of those unemployed because they were laid off fell to its lowest in 4 years in November. Supporting this, layoffs measured by weekly claims for unemployment insurance remain low. Job churn, however, has certainly slowed. The quits rate, measured by the Job Openings and Labor Turnover Survey, ticked up in October, but remains well below its pre-pandemic average as the labor market has meaningfully loosened. The hiring rate has also declined as payroll growth has decelerated over the past 2 years. Low layoffs but slower hiring have made it a good time to have a job, but a tough time to be looking for one. In November, the share of unemployed people who have been without a job for 15 weeks or more held at 40%. And this is a continuation of a meaningful rise in the duration of unemployment in the second half of 2024. Taking the payroll and employment reports together, the November jobs report does not represent a material deviation from the labor market's trend in the second half of 2024, and the rate-setting Federal Open Market Committee is not expected to alter its near-term plans. Moody's Analytics assumes another quarter-point cut to the central bank's primary policy rate when the FOMC meets in a few weeks.
Thanks, Moody's. So in 2024, the U.S. navigated really a mix of highs and lows. The labor market remained strong. Unemployment was hovering at historic lows of around 3.5% to 4%, really driven by a robust job growth. And we saw an influx of immigrant workers. Real wages rose slightly, supporting consumer spending. Inflation was still stubborn, but especially we saw it in areas specifically like shelter and auto insurance. Although broader disinflationary trends persisted, particularly in goods prices. On the downside, rising interest rates and tightening credit conditions constrained consumers and businesses really alike. Delinquencies on credit cards and auto loans increased, reflecting stress among lower income households. Meanwhile, we saw that the housing market was somewhat stabilized, really, though, at lower activity levels. And that was really hindered by those higher mortgage rates that we saw. Despite these challenges, though, corporate investments in areas like artificial intelligence and public infrastructure really helped to offset the broader economic headwinds. So what I want to do is I want to dig a little deeper into some of these areas. Probably one of the most talked about areas of the economy this year has been interest rates, really very similar to last year. So Dave, talk to us a little bit about where interest rates went this year and maybe some of the reasons behind these movements, as well as where we are with inflation.
Yeah, thanks, Jesse. So going back to January, right? So coming out of the pandemic and the choices made by the FMOC to combat inflation in 2023 had us starting off the year at 5.5% federal funds rate. And it remained there until September when the committee made its first rate cut, and it was a 50 basis point rate cut. So that lowered it to 5%. And really, the Fed was trying to achieve a soft landing, meaning keeping the economy out of recession. And so for the most part, I think most economists would agree that they've done a fairly good job at that. And another rate cut happened last month, November, 25 basis points, knocking it down to 4.75%. And I believe that we're expecting at least another 25 basis points this month. So the continued cuts are the Fed seeing that the economy is good from a jobs perspective and consumer spending, which leads me to my next topic, inflation. And inflation has been on the mind of every American for the better part of this year. You could say it impacted the election, both nationally and locally. People were fed up paying $4 for a carton of eggs. Now, a lot of that blame for inflation has been put on the Biden administration stimulus. But going back to the egg example, we had a severe bird flu outbreak that caused that. And, no one can predict a bird flu epidemic. So there were some outside forces here. So overall, over the last 12 months, consumer price index has been at 2.6%. Food, which are eggs inclusive in that, 2.1% higher. On a positive side, energy is actually down almost 5%, which is surprising given all the turmoil in the Middle East. And then all other items within CPI are up about 3.3%, and I think the rest of the team will give us some more details and impacts around that.
Yeah. So I guess, Dave, the biggest question I've got for you is, are you willing to make the call on soft landing?
Sure. Why not? I can be wrong again for next year. Foreshadowing.
Good. Yeah, well, we'll certainly look forward to that in next year's predictions. So, yeah, that's great insight, and it'll be exciting to figure out, what interest rates are doing in the future. I think, though, Aliff, it's probably a great time to talk about the housing market. And, after what we've heard from Dave, can you do a quick recap on the housing market, really what we've seen in 2024?
Yeah, sure. And it's been, I've really enjoyed our conversations on this, behind the scenes, and you may hear me repeat a few things that you've even said, to me.
Yeah.
But I guess starting in October, is as we think about some of the things that have occurred, mortgage rates experienced significant volatility. Rates were taking direct cues from the bond market, which in turn takes cues from several sources of information to be able to have those things fluctuate, such as economic data, inflation, some of the things that Dave was just referring to, geopolitical events, fiscal policies, and monetary policies. And there's been some reprieve that started to take shape a few weeks ago, but the underlying bond market is still jumpy, though some of that volatility did die down a couple weeks ago as well. Some key things to point out is when we're looking at the average 30-day or 30-year fixed rate, it held inside a narrow 5 basis point range, and it ended at the same levels just a couple Fridays ago. When we look at the rates being it's almost like there's some fear of stronger economic data with more persistent inflation and overabundance of government debt, that can help put upward pressure on rates behind the scenes. And so we see all this stuff happening that we know that it's not directly tied to the Fed funds rate. So in order to see some bigger drops in the to a lower level, as we've seen the Fed fund rate drop, we need to see the most closely watched economic reports come in weaker, and for inflation to drop below target levels month over month, I guess from a month over month standpoint. And then when we look at the 30-year mortgage rates, the way some of that math roughly adds up to it makes up about 10-year Treasury benchmark plus the mortgage spread, when we consider how that operates. So when we look at the spreads and what have occurred through that, is they've gone from about 175 basis points historically to 250 basis points as more interest rate volatility has entered the picture. And as we then consider investors placing demand on a higher spread during times of higher volatility, as there is a risk of prepayments that will occur. And the spread then is also a function of monetary policy. As Fed cuts the short-term rates, the yield curve becomes more positively sloped, removes volatility, and allows spread to come to something a little bit more typical. And some of the things that we're also continuing to track around that are the delinquency rates. And some of the things that we have observed was like the 2023 vintages, for example, had a little bit higher delinquency rates than the prior vintages of more recent years as well. So we're just really trying to understand and unpack what's happening from an origination standpoint, which origination is going to be primarily driven by the rates, which have a lot of things that are incorporated in terms of determining that.
Yeah, that's great insight. I think when you look at the yields or the yield curve and the spreads, I think that nuance is really interesting to me, especially as I think about as a home seller. I think about you've gotten past the election, and it seems like things would settle down, but we've actually kind of seen some volatility that have kind of pumped that market a little more than we would have expected. So yeah, that's great. Thanks for that insight. So another area where I'd like to touch on is employment in the labor market. We saw in the labor market in 2024 that we were normalizing or somewhat slowing. I guess it really depends on which word you like better. And I would say that we really saw resiliency. Our job creation numbers showed most months with a 3-month moving average of job creation above 150,000 jobs. That's really a sign of stability. And we also saw that there was an increase in the unemployment rate from the mid to low 3% range to around 4%. And again, that's really normalizing. That's moving to a level that we saw pre-pandemic. We triggered the SOM rule, which I think maybe gave a lot of people a new economic term to fret over. Probably, not anything to worry about. But we also saw Americans saw their wage gains outpace inflation in the last half of the year. Job openings, hirings, and the quits rate were all down. So I think if I sum up the narrative for the labor market in 2024, what I would say is that it's a great market if you have a job. It's maybe not the best market if you're looking for one. So that's kind of where I would see labor and employment, at least as we look back to 2024. I tell you what, Maria, now that we've kind of heard a bit about interest rates, inflation, housing, and now the labor market, can you help us dig maybe a little deeper on the impact these areas have had on Americans?
Of course, Jesse, and the American consumer has faced credit and financial challenges beyond the cautious optimism mindset, leaning more towards the need to be cautious towards the end of the year through October. The higher interest rates to curb inflation have led to increased borrowing costs. Based on the Federal Reserve, for example, the average interest rate on credit card accounts with a balance was 23.4 in August. Forbes average numbers this week are tracking above 28.7%, while others are calling low 23s. So we have continued to observe many households turning to credit cards to meet basic needs, resulting in a surge in credit card balances, expensive debt to carry. Overall, revolving debt currently stands at 1.2 trillion, 5.2% year-over-year increase. And refer to the housing market. The average mortgage interest rate for a 30-year fixed loan stands at almost 7%, with a national median home price over 416,000 and an average sales price over 510,000. So this has led to postponement in home owning plans. In some cases, for those with a mortgage, Jesse, you referred to this, postponement on refinancing anytime soon. If you add on top of this the additional student loan payments that resumed last year, paired with delinquency reporting this October, consumers are reassessing their financial priorities. And on the other hand, the consumer confidence index has increased in November over October, particularly among the less than 35 age group and in the middle income earner group. So there is optimism in our cautious optimism 2024 theme. It's still present this holiday season.
Yeah, that's certainly good to hear. Do you think, we've talked a lot about the K-shaped economy. Do you think is that still kind of prevalent with what we're seeing?
I think it goes hand in hand with that cautious optimism and that disparity, right, between households. So that's why I've called out the age differences and income differences for sure. Yeah.
Well, certainly a lot of moving parts to keep track of. With what we just heard from Maria, Tom, affordability, I think, is probably one of the biggest areas of concern still for the economy. Can you talk to us a little bit maybe about how affordability changed, or maybe it didn't change this year?
Yeah, I love having the most generic of all of the topics, which is awesome because I was waiting to see what everyone else was going to say about their topics to see, okay, what's left over for me, because really affordability is it touches on, well, not even touches, it is comprised of everything that Em and Maria and Dave and you have talked about, everything from the housing prices to the K-shaped economy to the price of eggs. I mean, if we look at it, if we step back, it really boils down to how capable is the average consumer, or not even the average, any consumer, able to meet, pay for the things that they need or want to pay for. And once that's done, how much is left over to put into investments, to put into savings, to make plans. So really affordability is this grab all term that impacts all aspects of someone's financial well-being. And just to pull from some of the examples that the rest of the team here was speaking about, Marie was talking about the average home prices and how the 30-year mortgage rates right now are about 7%. If you think about that, the existing mortgages, mortgages on existing homeowners, that's less than 4%. So put yourself in that position of someone who maybe I'm considering moving, maybe I'm considering upsizing or downsizing, but I'm sitting here at a 4% mortgage rate, and I know that if I need to make that change or want to make that change, it comes with a cost of taking that 7% mortgage rate on top of paying for a house that's now much more expensive than it was just a few years ago. So that's obviously a fundamental impact to those financial choices that I'm going to make. And given that Americans have so much of their wealth tied up into their homes, into those holdings, that's going to impact a lot of other aspects of their financial well-being. So everything from Dave's carton of eggs. Is it a carton of egg or a package of eggs? I think it's a carton of eggs. Anyway.
Yeah, I think carton. We'll go with carton.
Carton's probably right. So everything from that decision to what I am buying at the grocery store, to can I afford to get a new car, or do I send the existing one into the shop for now? To am I in a position to move or to get a larger house or to downsize? All of these things are impacted by what we're calling affordability. And one other example of that is even as we head into the retail season, the holiday season, how much are consumers going to be willing to spend and be able to spend? One of the things that there's a lot of talk about, prior to the Fed cutting rates was when they do cut rates, one of the first things that we should see is a drop in credit card interest rates, and maybe that'll help delinquencies, and maybe that'll help spur some more spending and utilization on those cards. Well, the Fed has cut rates, as Dave said, and we have seen a little bit of a drop, as Marie was saying, in those average interest rates in cards, but it hasn't been much. And it certainly hasn't, swung the needle in terms of card originations and motivation to spend more on that revolving balance. So even there, we're seeing again, this impact of affordability from the very small, buying those eggs, to the very large, buying the house or not buying the house. So it is something that will impact and continues to impact all consumers, regardless of where they fall in the income hierarchy, the credit score hierarchy. It'll impact them differently for sure, but it impacts everyone.
Yeah, so I think what I hear then is the theme affordability is really broad, and that definition really means something potentially different to each borrower. It sounds like.
Absolutely.
Yeah. Well, I have a sneaking suspicion then that we're going to be talking about affordability well into 2025. So I'll go ahead and close this section out then and talk a little bit about some of the key macroeconomic threats that we focused on in 2024. We've talked about a topic it's been around since the pandemic. It's the rise of student loan delinquency and debt, and I think Maria kind of spoke to it as well. But we saw the resumption of delinquency reporting this year with student loan, at least federal student loans, and we're no doubt going to want to watch the impact of this really on the federal student loan debt holders into 2025. We also saw some impact of high-profile labor disputes. We had the dock workers dispute, the Boeing and Samsung disputes. This comes on the heels of big labor disputes in 2023. And I think, as an example, the Boeing strike, I think, impacted around 50,000 jobs in the October report. A few others that come to mind, certainly we had, and leading up to November 5th, we knew that the election was going to potentially kind of be a bumpy season. now that the dust is settled, it seems like the market and the economists are really turning their attention to what the policy impacts might be. What are the impacts that we can see on the economy with the policy changes coming forward? And then finally, never to forget, we still have, active war conflicts going on across the globe. So I think that the one certainty that we have is that we're going to continue to see these macro conflicts, whether they have an impact on the economy, which most, seem to at some, to some level. We just, would continue to watch the severity of how they do impact the economy. So yeah, great information. Love the insight about 2024. Again, can't wait to see what the predictions are for 2025. This is a fun part though. So we've come to the lightning round. And what I want to do now is I want to recap the 2024 predictions that we made from our podcast at this time last year. So I think it was around December when we made this podcast looking forward to 2024. Specifically, were we close? Did we hit the mark or were we way off? And so the rules of this game is we want to keep it short and sweet for the listener. So 1 minute or less. So this is the lightning round. Dave, how about your predictions?
All right. So since I'm still here a year later, I'm not very good at predicting the future, hence the lottery winning. So my prediction was around BNPL and the requirement, some regulatory requirements around reporting. And so while there were some movement by the CFPB around stating that BNPL issuers are just like credit card issuers, meaning that the card holders as well as the BNPL holders have the same rights no matter what. And so that really was the only regulatory movement on the BNPL front. So I am going to take a big negative on being accurate.
All right, so we're 0 for 1 then. That's what you're saying, huh?
Yes.
All right, I'll keep tally. So Em, you're up. How did we do last year with your predictions?
All right, let me start my timer. So I had 4 things that I wanted to talk about that I thought would transpire. The first one was student loan repayment shocks. I still think that we are anticipating that shock to occur because those payments, just went back in place. And as we all know, there was not forgiveness, outside of the small modicum amounts that were forgiven. So I do still anticipate that there will be some pretty heavy shock with respect to those people who are unable to have the affordability met. Then pivoting, I did talk about the auto market a bit because of the boom in 2020 and 2021 with the equity, what's happening in those spaces with the amortization schedule and vehicle values. We have seen some of those things occur. Specifically, some of the credit union meetings that that I've been in, where seen large numbers of people walking away from their car, leaving it in the lot. Now, delinquencies have not gone to anything that's out of control necessarily, but we have seen that rise. So we've seen some increases in delinquency, specifically from the vintages that we were referring to, and as delinquencies have been rising, that does create the need. We predicted that there'd be more interest in portfolio reviews. We have seen that interest continue to grow and evolve, and even in places we're seeing some things like securitization in that space. So I do think that I would give myself probably 75% accuracy versus 100%.
Oh, now you're going to make it hard. So we're 0.75 to 1.
Yeah,
Is that it?
That falls more into the. I think that falls more into the TBD than a yes or no.
Quantum physics is a hobby of mine, so
I think it's 0, 1, and 1 for a tie. Yeah.
All right, 0, 1, 1. All right, that sounds good. Maria, how about you?
Well, I'm more on the following Dave's steps, I think. I had predicted increases in the volume of strategic defaulters on student loans and uncertainty around the income repayment plan. So maybe just slightly hitting the last one, but we have experienced servicing failures and setbacks. And in fact, the federal student aid within the Department of Education is currently conducting audit of the federal student loan files that were previously in default. So we have yet to receive the data. I talked to the data contributor team at Equifax, and it might take another 2 weeks. So yet to be determined. We don't have that data. We thought we would by now, since reporting resumed in October, but we have yet to wait even for the files.
All right, so I'm going to go out on. I think that's a 1. I think that's a win. So we'll go 1-1.
That
Glass
kind of
half
sounds
full, there
like
you go.
another TBD to me.
Glass half full.
Yeah,
Jesse.
TBD.
You know what? I'm the host this time, so I'm
Okay.
calling it a win.
Okay.
So we're 1-1-1. How about you, Tom?
So first off, Maria,
got AI, right?
I think I know what your problems were. You both made predictions that depended upon some regulatory body to take action or do the right
Yes.
thing. So
Yes.
that's the problem right off. So going into 2025, you know what to base your predictive powers off of. So I am going to boldly claim that mine was a complete hit. When my prediction. I said that 2024 was the year that AI was finally going to actually have a substantial impact on the financial industry. And I'm almost embarrassed, how right that was. It almost makes it seem like it was a gimme prediction, back at the time, though it wasn't. But we have obviously seen AI take hold beyond the customer service beachhead that it started with in the financial industry. It's involved in investment strategies and risk management, fraud detection, customer services, obviously, planning, advisory services, on and on. And I think we're just beginning. So yeah, I think I can chalk up a victory on our side here.
W on that one, huh?
A W there. Yep.
If maybe an easy prediction, but that's okay. We'll
It didn't seem like it at the time. Okay. I'll give myself that.
Hindsight's 2020. Okay. All right. So I'm going to go last. I have a confession to make. Last year, my prediction was that we would see the first federal rate cuts, and that the cuts would have impact on originations. And so I'm gonna fall on the sword and say that was kind of a prediction. But I will say that one of the things that did surprise me is kind of what Em said, is the impact really that the election had on Treasury rates and the flow through to 30-year fixed mortgage rates. That was something that I didn't necessarily kind of think about. So certainly really interesting to to kind of see the impact that the election had and still has. So if I did my math correctly, I think we're 2-1-2. I'll give it 2-1-2. So not that bad. Certainly, maybe a good barometer for where we want to beat next year. So yeah, as you can see, though, we had some calls, they were on the money. Others were near accurate, and then some of us, like myself, stated the obvious. I certainly look forward to our predictions in 2025, this time next year, to see how accurate we were. So with that, I want to thank Dave and Maria and Tom for joining me today. And to our listeners, I want to say I hope you enjoyed today's topic. More importantly, from all of us at the Equifax Advisors, I hope you have a healthy, safe, and fun holiday season. If you have any questions, you can certainly reach out to us, especially if you have ideas for a future podcast. Reach out to us at riskadvisors@equifax.com. We look forward to hearing from you.